Gold is at 4,680. That is a 16.5% collapse from the January 28 record high of Fib 602. Silver is at 72.40, down nearly 40% from its all-time high of 121.67. Those are not rounding errors. Those are structural resets. OG John AG here. Drop OG John AG in the comments if you are here paying attention and actually learning. Now, the Federal Reserve just delivered one of its most hawkish pivots in years, and the gap between paper price and physical reality is widening every single session. Let's get straight into it. Before we go further, if this kind of data-first analysis is what you have been looking for, hit the like button right now. Subscribe to OG John AG 1.0 and share this with one person who needs to see these numbers. Now, back to the data. Lead story today. The Federal Reserve. Policy rate held at 350 to 375%. Updated dot plot signals 0 to 1 rate cut for the remainder of 2026. That is a reversal from 3 cuts previously projected. Effective immediately in market pricing terms. This follows a producer price index print of plus 0.7% month over month, more than double the 0.3% consensus, with the year-over-year rate accelerating to 3.4%. The unusual detail here is not the hold, it is the simultaneity. A hawkish Fed pivot, a hot PPI print, an Iran conflict driving oil above $100 per barrel, all landing in the same week. The timing is what deserves scrutiny, not any single event, the timing. Think about what that sequence actually means. The Fed is trapped, raise and you crack growth, cut and you re-accelerate inflation. Hold and the market price is the worst of both. The ones paying attention already know what to watch next. Before I show you the full data picture, consider this. Shanghai physical silver is trading at $78 to $80 per ounce right now. COMEX paper silver settled at 71.25, that is an $8 gap. The last time sustained physical premiums of this magnitude appeared in Asia, the Western paper price corrected sharply upward within months. The data is already telling you something. Let's build it out. Now let's build the full picture because the Fed decision does not exist in a vacuum. The dollar index, tracked by the ICE US dollar index, has climbed toward 106.00 hours following the Fed statement. The 10-year U.S. Treasury yield, reported by the U.S. Treasury Department, sits at approximately 4.28%, near its highest level since August. COMEX, operated by the CME Group, shows gold futures volume down 25% from the pre-war average. COMEX gold options volume is down nearly 40%. The SPDR Gold Trust, the world's largest gold ETF, has shrunk to its smallest size in 9 weeks as leveraged holders de-risk into the weekend. On the silver side, COMEX registered inventory sits at approximately 103 million ounces. Total open interest represents approximately 429 million ounces of paper claims. That is a 24% coverage ratio. In a single week earlier in 2026, 33.45 million ounces, roughly 26% of registered inventory, were physically withdrawn from COMEX vaults for delivery. The rate of drainage is not slowing. It is compounding. The data is doing the talking. The ones who have been called alarmists for flagging this inventory structure, they are not saying much right now. And here is what makes that picture even harder to ignore. Shanghai Gold Exchange physical silver at $78 to $80 versus COMEX paper at $71.25. That is an $8 to $8.75 premium, approximately 8 to 12% above the Western benchmark. At the same time, COMEX open interest of 429 million ounces sits against only 103 million ounces of registered deliverable stock. That is not a contradiction. That is the setup. And before anyone takes that as a green light, setups can take a long time to resolve. What this tells you is the structural picture. The timing is a completely separate question. Anyone who claims to know the timing is selling something. Now, the Iran conflict, because this is no longer a backdrop, it is the primary variable. Here is the number most people are not talking about. 21 million barrels per day through the Strait of Hormuz. That is approximately 20% of global oil supply through one choke point. Oil is already trading above $100 per barrel. The Iran conflict, involving active U.S.-Israeli military operations, has created a supply risk premium that is now embedded in energy markets globally. Every dollar on oil adds to U.S. inflation expectations. Every inflation expectation print delays Fed rate cuts. Every Fed delay strengthens the DXY. Every DXY strengthening suppresses paper gold and silver prices mechanically. That is the chain. Follow it. Markets are still pricing a resolution scenario. Look at COMEX futures volume, down 60% in silver from early 2026 levels. And tell me what probability the market actually puts on a clean near-term resolution. When markets start pricing the reality of what sustained $100 plus oil actually means for a stagflationary Fed, gold reprices higher. Silver reprices higher. That is the historical pattern. Every time this sequence has appeared, stagflation plus geopolitical supply shock plus central bank policy paralysis, it has not been different yet. Gold Western Spot at $4,680. Shanghai Gold Exchange pricing in USD terms carries approximately a $40 to $70 premium above COMEX Spot. Shanghai Silver Physical at $78 to $80. COMEX Paper Silver at 71.25. The short-term picture is binary. If the DXY holds above 106 and the Fed shows no pivot signal, paper prices remain under pressure. If any ceasefire signal emerges from the Iran conflict over the weekend, oil retreats, dollar softens, and gold reclaims 5,000 rapidly in thin early Asian trade as short covering accelerates. That is the only short-term read that matters right now. As for trading it, I cannot see a clean picture on the lower time frames right now. I cannot tell you what gold does Monday morning. Nobody can. If you think you know, good for you. This is a weekend gap environment with active geopolitical risk, thin futures liquidity, and a Fed that just broke market consensus. Sidelines is not weakness in this environment. It is the only edge there is. I have called this market both directions. I will call it again when I see it clearly. Right now, I do not see it clearly. The tape decides, not me. Here is the honest truth. Both sides of this trade have a real case, and the one you ignore is the one that will cost you. So let's run both. The bear case is real. The DXY at 106 mechanically suppresses all dollar-denominated commodities, confirmed by ICE data. The 10-year Treasury yield at 4.28% raises the real cost of holding non-yielding gold, confirmed by U.S. Treasury data. Silver futures and options volume is down 60% from early 2026 levels, confirmed by CME Group, meaning thin markets amplify downside moves. The bull case is equally real. Shanghai physical silver trades 8 to 12% above COMEX paper, confirmed by Shanghai Gold Exchange data, signaling physical demand that paper selling cannot eliminate. COMEX registered silver at 103 million ounces backs 429 million ounces of paper open interest, a 24% coverage ratio confirmed by CME Group warehouse reports. JP Morgan projects gold at $6,300 per ounce by year-end 2026, placing this sell-off inside a larger structural bull market. Size correctly. Know what you are in before you are in it. The physical market already knows where this is going. The paper market is still arguing. That argument does not last forever. Everything shown today points to one structural reality. The paper market is pricing a resolution that the physical market is not confirming. The $8 Shanghai premium, the 24% COMEX coverage ratio, the 40% decline in silver futures volume, 3 separate data sets, one consistent signal. Don't take my word for it. Verify every number I gave you today. Check the data yourself. CME Group warehouse reports at cmegroup.com, Shanghai Gold Exchange data at sge.com.cn, U.S. Treasury yields at fiscaldata.treasury.gov. Logic over hype, always. If this analysis added value, like this video right now. Subscribe to OG John AG 1.0 so you never miss a data drop. Share this with one person who needs to see these numbers. The ones running the OG John AG 1.0 playbook do not wait for the mainstream to catch up, they already know. OG John AG 1.0, out.